Welcome back to Investing Talk Podcast.
Today we're looking at Palantir.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us out.
It definitely does, and we have a really fascinating one for you today.
We really do. If you are, prepping for a strategy meeting or trying to catch up on the enterprise tech landscape or just insanely curious about where artificial intelligence is actually heading beyond just the chatbots, you are absolutely in the right place.
For sure, because our goal today is to unpack a highly detailed strategic analysis on a company you've almost certainly heard of, but you might not fully understand.
Right.
We are going to dig into the fundamentals, the market sentiment, and the real-world applications of Palantir to figure out what is actually going on under the hood.
And to start us off, I have to share this paradox that just, it absolutely grabbed my attention.
Oh, the divergence, yeah.
Yeah, the setup here is wild. So Palantir just reported staggering growth for the fourth quarter of 2025. We are talking about a 137% jump in their U.S. commercial revenue.
Which is explosive.
Explosive, exactly. Yet right now, their stock is sitting roughly 35% below its recent peak.
It's a massive disconnect.
It really is.
And honestly, it's the kind of divergence that makes you stop and pay attention.
Right, because it immediately begs the question, which we are going to explore with you today. Is this 35% drop a massive red flag waving in the wind like signaling the AI bubble is leaking air? Or is this an incredible multi-year opportunity hiding in plain sight?
And to figure that out, we really have to look past the daily noise of the stock market ticker.
Yeah.
Because the daily price action rarely tells the whole story, especially with a company that is this heavily scrutinized. Today, we need to strip away the hype, look at the fundamental engine driving the business, and then connect their raw financial data to the broader tectonic shifts happening in the AI landscape.
So let's transition right into the fundamentals, because it's hard to reconcile that stock drop when you actually look at the balance sheet.
Right, absolutely.
The numbers coming out of their recent reports are almost hard to believe. Let's look at Q4 of 2025. They reported revenue of $1.41 billion.
Right.
That is a 70% jump year over year. And for the full year of 2025, they pulled in roughly $4.48 billion.
And we really need to pause on that 137% U.S. commercial revenue growth you mentioned earlier.
Yeah, let's unpack that.
Because that specific metric is the key to their entire narrative right now. For the longest time, the knock against Palantir, the stereotype that kept a lot of traditional tech investors away, was that they were essentially just a bespoke, highly secretive consulting firm for the Defense Department and intelligence agencies.
The old government contractor label.
It's exact.
People thought their total addressable market was basically just the Pentagon and MI6.
Precisely. But putting up 137% commercial growth completely shatters that stereotype.
Yeah, it does.
It proves their artificial intelligence platforms are being aggressively adopted by private businesses. They aren't just selling to generals anymore. They are selling to corporate America. And corporate America is buying at an unprecedented rate.
They're crossing the chasm.
They've successfully crossed it, from a government secret weapon to an enterprise necessity.
And here's a metric that made me do a double take. Have you ever heard of the Rule of 40?
Oh, the software benchmark.
Right. For anyone listening who might not spend their day swimming in financial modeling, the Rule of 40 is a benchmark used to measure the health of software companies. You simply add their revenue growth rate to their profit margin.
And if the combined number is 40 or higher, the company is doing great.
Exactly. It means they are balancing growth and profitability. Well, Palantir just hit a Rule of 40 score of 127%.
Which is insane.
Honestly, when I first read that, I thought someone in accounting misplaced a decimal.
It really does sound like a typo. To give you some context on how rare that is, hitting 40 is a sign of a very healthy, balanced software business. Hitting 60 or 70 puts a company in elite, rarefied air.
Right.
Hitting 127% is almost absurd. It proves something incredibly vital about their business model. They are scaling their AI operations at breakneck speed, but they aren't bleeding cash to do it.
Which is usually the trade-off, right? Hypergrowth tech companies traditionally burn billions of dollars to acquire market share.
Yeah, hoping to figure out profitability a decade later.
Exactly. The old Silicon Valley playbook is to subsidize growth with venture capital or shareholder dilution. But Palantir is achieving hypergrowth while simultaneously expanding their profit margins.
And speaking of not bleeding cash, we have to talk about their free cash flow.
Oh, absolutely. Let's look at the cash.
In Q4 alone, they generated an adjusted free cash flow of $791 million.
Wow.
That means 56% of their revenue is turning into pure cash.
56%. That is a massive margin.
Cash is king, especially in the current AI arms race. Because they have incredibly low debt and these rapidly growing cash reserves, they possess a massive strategic advantage over their competitors.
Because they can fund their own growth.
Exactly. They can aggressively reinvest that $791 million right back into expanding their AI platforms, hiring top engineering talent, or making strategic acquisitions.
Without needing a bank.
Right. They don't have to go to the bank for expensive loans in a high interest rate environment, and they don't have to issue new shares and dilute their current shareholders just to keep the lights on. They are a self-funding growth machine.
Okay, so that cash flow is undeniable. But cash only matters if you have a product people actually want to keep buying. What exactly are they selling that has global enterprises handing over cash hand over fist?
That is the big question.
Let's break down their core products, Foundry and AIP, which stands for Artificial Intelligence Platform.
This is where we need to define the protective barrier that keeps competitors from stealing their lunch. Think about the current AI boom. Everyone talks about NVIDIA.
All right, the chips.
NVIDIA has a near monopoly on the hardware, the physical GPUs that make training large language models possible.
Yeah.
What we are seeing is that Palantir has essentially built an equivalent moat, but in the software layer.
Okay, hold on. That is a massive comparison. NVIDIA is the undisputed king of the hill right now.
They are.
To say Palantir is building that same dominance in software, I have to push back a little. Why is it so hard for a competitor like, say, Snowflake or Databricks or even Microsoft to just copy what they're doing?
It comes down to something called an ontology combined with brutal switching costs.
An ontology. Okay, explain that.
Most software just sits on top of a company's data and analyzes it. Palantir's platforms, like Foundry, integrate deeply into the very nervous system of the enterprise.
Like a digital twin.
Exactly. They map the physical reality of a business, every factory, every supply chain route, every employee into a digital twin. They connect the siloed supply chain data to the HR data to the financial data.
So it's not just a dashboard you log into. It's literally an operating system for the entire company.
Yes. And once a sprawling global corporation integrates that kind of system to run its complex AI operations, the cost and the operational headache of ripping that software out and replacing it with a competitor becomes unimaginably high.
You're locked in.
You'd basically be trying to perform brain surgery on a living organism while it's running a marathon. You just don't do it. They become totally indispensable.
And the more data that flows through the system, the smarter the AI gets, creating a network effect that constantly widens that competitive moat.
Precisely.
And we aren't just talking in theories here either. The recent data provides some concrete, real-world partnerships that validate this demand. Just recently, they partnered with InnoData for AI data engineering, specifically in the defense sector.
Right.
They partnered with Rackspace to collaborate on AI deployments for cloud infrastructure. And OneMedNet just announced they are launching a real-world data platform entirely powered by Palantir Foundry.
And see, those aren't just shiny press releases designed to pump the stock.
No.
If we connect this to the bigger picture, these partnerships are vital proofs of concept. You have defense, you have cloud infrastructure with Rackspace, and you have highly regulated healthcare data with OneMedNet.
Completely different industries.
Exactly. It validates that this AI ecosystem has end-to-end utility across completely different silos. A system that works just as flawlessly for a hospital network managing patient records as it does for a military logistics supply chain is incredibly rare.
All right, let's step back and look at the whole board here. We have 137% commercial growth. We have a Rule of 40 score of 127%, massive free cash flow, an enterprise software moat that rivals NVIDIA's hardware moat, and real-world adoption across multiple, highly complex industries.
Which brings us right back to your opening paradox.
Exactly. Let's move over to the sentiment and the technicals. Why on earth is the stock sitting 35% below its recent peak?
It is the golden question.
If we look at the technicals, the stock has been trading below key moving averages. The 20, 50, 100, and 200-day lines, and the RSI, the Relative Strength Index, is hovering near 38.
Right.
Now, for anyone tracking the technicals, an RSI 38 tells us the stock is bordering on oversold territory. The sellers might just be running out of steam.
True.
But still, when analysts call a 35% drop a healthy corrective base, it sounds a bit like Wall Street spin to me. How is a drop like that ever actually a good thing?
I completely understand the skepticism. It is a striking contradiction, but this is where sentiment and technical analysis provide a different lens than pure fundamentals.
Okay.
When a stock runs up as fast and as aggressively as Palantir did throughout 2024 and 2025, it eventually has to take a breath. Momentum traders get exhausted.
So it's just a cool down.
Yeah, the healthy correction narrative isn't just spin. It's about shaking out the short-term speculators and weak hands. It allows the stock to establish a new, solid floor based on its actual earnings power rather than just hype.
So it's resetting the baseline.
Precisely. And what's really telling is how the major financial institutions are reacting to this drop.
It's the big money.
Right. We saw UBS recently upgrade Palantir to a buy. They specifically cited the massive AI data demand and noted that this 35% dip is a highly attractive entry point.
Interesting.
They don't look at this chart and see a fundamental flaw in the company's business model. They see a premium asset that got a little ahead of itself and is now temporarily on sale.
And UBS isn't alone in that assessment. The street has set some very aggressive price targets for 2026. You have Northland targeting $190. Citi has a target of $235, and Citigroup is all the way up at $260.
Those targets aren't just wishful thinking either. They are backed by actual capital moving into the market.
Yeah, the 13F filings.
Exactly. If you look at recent 13F filings, we are seeing massive institutional accumulation. We're witnessing what analysts call cluster buying by the smart money.
So while retail investors are panicking over a 35% drop,
Yes. While retail investors might be looking at their brokerage apps and getting scared, the massive institutional funds are quietly, methodically using this dip to load up their portfolios. They are playing a multi-year game.
that institutional backing is a huge vote of confidence. But let's zoom out to the broader macro environment. What is going to drive the stock back up toward those price targets?
We have to look at the catalysts.
Right. There is a lot of chatter right now, and we should be clear that some of this is unconfirmed, about expanded U.S. government contracts, potentially flowing to Palantir following a recent ban on certain AI models.
Like the Anthropic ban.
Yes, the ban on Anthropic in specific government use cases.
That geopolitical angle is crucial. When we talk about AI in the enterprise space, we talk about efficiency. But when we talk about AI in the government and defense space, we are talking about national security.
And when a government suddenly restricts consumer-grade or less secure AI models because of data privacy or security fears, they still need to process that data.
Yeah.
They have to turn somewhere.
Exactly. And Palantir, with its deep roots in building secure defense-grade software for the intelligence community, is the natural beneficiary of that security scrutiny. They are essentially pre-vetted.
There's also talk of Palantir gaining serious traction with European sovereign cloud partnerships. Now, sovereign cloud is one of those buzzwords that gets thrown around a lot. What does that actually mean in practice, and why is Europe so focused on it?
It's a massive issue for Europe right now. A sovereign cloud essentially guarantees that a country's data stays within its own physical borders.
Okay.
It is governed strictly by its own privacy laws and isolated from foreign intelligence surveillance. European nations are increasingly terrified of U.S. tech giants having unchecked access to their citizens' data or their government infrastructure.
So they want complete control.
Right. By offering sovereign cloud solutions where the software is deployed locally and disconnected from the broader internet, Palantir is providing a highly secure wedge into the European market that companies relying on public cloud infrastructure just can't match.
That makes total sense. So they have the geopolitical tailwinds.
Yeah.
But looking at the broader economy, the macro picture seems to be aligning in their favor as well, doesn't it?
It really does. As of February 2026, the Nasdaq has rebounded nicely, closing around 23,238.
Yeah.
Couple that broader market strength with the potential tailwinds of interest rate cuts, and we are seeing a major sector rotation. Capital is flowing back into AI and high-growth software companies.
Even back to quality.
Exactly. That macro environment heavily favors a company with the kind of cash flow and growth metrics we discussed earlier.
So for you listening, what is the next big date to circle on your calendar to see if this thesis holds water? The consensus points heavily to the Q1 2026 earnings report, which should drop in late April or early May.
That is the one to watch.
The street is already expecting another massive 60% plus growth beat, driven primarily by that continuing U.S. commercial ramp-up.
That earnings report will be the ultimate proving ground. It's going to be a binary event.
Oh, so.
It will either validate the institutional cluster buying we're seeing right now, or it will prove the skeptics right.
Which is the perfect time to pivot to the risk profile.
Yes.
We always play devil's advocate here because you deserve a balanced, realistic view. We can't just talk about 137% growth and ignore the potential pitfalls.
Absolutely not.
If everything is so perfectly aligned, what is the bear case? What could derail this?
The primary risk, and it is a significant one that investors cannot ignore, is valuation sensitivity.
Okay.
Put simply, absolute perfection is currently priced into this company's future. Palantir has issued massive revenue guidance for the full year of 2026. They are projecting 61% year-over-year growth, taking them to roughly $7.19 billion in total revenue.
$7.19 billion. That is a staggering target to hit.
It is. And the market is pricing the stock today as if that target is a guaranteed fact.
Oh, I see.
This raises a critical question about margin of error. At their current valuation multiples, even after a 35% pullback, there is absolutely zero room for a misstep.
No safety net.
None. If they report earnings and that commercial growth comes in at, say, 58% instead of 61%, the market will punish the stock immediately and severely.
Because it breaks the narrative.
Exactly. When you are priced for hypergrowth, any slight deceleration, even if the company is still growing at a rate most businesses would kill for, causes momentum investors to head for the exits. You see massive multiple contraction.
Right, the expectations are just astronomically high. You're priced for a marathon sprint, and if you stop to tie your shoe, the market leaves you behind.
That is a great way to put it.
There are also some supply chain and geopolitical scrutiny risks, particularly in the defense sector, which were highlighted by that Anthropic ban we discussed earlier.
Yeah, that is definitely something to keep an eye on.
Whenever you deal heavily with government contracts and national security, policy changes or administration shifts can happen overnight and disrupt your revenue pipeline.
That is a valid concern. Though it's worth noting that Palantir has a very heavy intentional focus on the U.S. and its closest allies, the Five Eyes nations.
Right, they aren't trying to sell to everyone.
No. By strategically embedding themselves into domestic defense infrastructure and U.S. commercial enterprises, they insulate themselves from a lot of the broader, unpredictable geopolitical risks that affect hardware companies.
Like the semiconductor manufacturers relying on global, highly fragmented supply chains.
Exactly. They are much more insulated in that regard.
Okay, we have covered an immense amount of ground today. We've looked at the soaring revenue, the incredible Rule of 40 score of 127%, the NVIDIA-like software moat driven by their ontology.
The moat is key.
We looked at the perplexing 35% stock pullback, the institutional smart money buying the dip, and the very real risks of a sky-high valuation requiring absolute perfection.
We covered it all.
So what is the final verdict here?
The broader analytical consensus concludes with a bullish score of 9 out of 10.
A 9 out of 10. That's a high conviction rating.
Yes, it is. The underlying thesis is that a company guiding for 61% growth, generating free cash flow at 56% of revenue, and possessing a deeply entrenched, practically irreplaceable AI moat is fundamentally exceptional.
Yeah, the numbers back it up.
The analysis views the current 35% pullback not as a warning sign of a broken company, but as a highly compelling entry point for a multi-year hold, targeting AI dominance through 2026 and well beyond.
It really is a story of incredible operational execution meeting very demanding market expectations.
And for anyone digesting this analysis today, the key takeaway is that knowledge is most valuable when you look past the noise. Don't get caught up in the daily, hourly fluctuations of the stock ticker.
Yeah, exactly.
Watch how they actually execute on their promises. Watch that late April Q1 earnings report. Do they hit that 60% commercial growth?
Right.
Do those partnerships with companies like Rackspace and OneMedNet translate into tangible bottom-line revenue? That is the fundamental data that matters.
Looking past the noise to find the signal. We hope this breakdown gave you some serious clarity on the mechanics behind one of the most polarizing and talked about companies in the tech world right now.
It's definitely a fascinating case study.
Before we let you go, I want to leave you directly with a final provocative thought to mull over. Something to explore on your own that builds on everything we just discussed.
I love this part.
We spent all this time talking about the companies that are integrating this kind of software to run their supply chains, their hospitals, and their defense grids. But what happens to the organizations that outright refuse to adopt it?
Oh, wow.
If an end-to-end AI operating system truly becomes the absolute gold standard for running a massive enterprise in a few short years, could trying to compete without one be the equivalent of trying to run a global Fortune 500 corporation today without using the internet?
Now that is a fascinating question. the cost of inaction might be higher than the cost of option.
Something to think about. Thank you so much for joining us today. Remember to subscribe, like, and comment to support the show. We will catch you next time.